All right. We should be live. All right. Welcome. Hey, what's up, Kyle?
How's it going?
Happy Thursday.
It is. It is.
Okay. So we just get
Got
the. Okay. Good. We are live. Thanks, Nick. Appreciate it. Let's see. Lots going on here at Inside Edge Capital, but I think we'll save some fun announcements for maybe next time. But we've got some good developments on this end. We've been working hard. Markets are solid. Good presentation. What's going on with you? Opening comments.
yeah, just busy. A lot, just to echo, a lot going on at the firm level. We made a hire we're
Yeah.
excited to announce. We'll do it next week, and yeah, a week from now will be my birthday, so that's the last big news that we've got a lot in the presentation, but
Happy
I'll be
25, buddy.
quite old. Yeah.
Yeah, right. All right. Well, speaking of birthdays, let's jump into that. Okay,
Yeah.
so October 9th already. Holy bananas. Did you know that Inside Edge just turned 4 years old?
4 whole years.
Yeah,
I
October 4th was our official launch. It's been awesome. So I think a lot of you guys know I was simultaneously running the wealth management and the research business. And I don't know, 3, 4 months ago, we finally shut down the research and focused fully on Inside Edge. So I think at the end of the presentation, I think we're going to show you what we've done in those 4 years, kind of look at how the portfolios have done, but we're gonna hold that until the end. But happy birthday
Mhm.
to us.
Yeah, it's been great. I've been here most of it, pretty much 3 of the 4 years, and I'd
Yeah.
say we've just in the last 6 months really graduated from like startup phase to like small business phase. So it's been great to be a part of the growth process and starting to really hit our stride, it feels like. So
Well said.
gotta love it.
Well said. Yeah, we're definitely firing. Markets, I mean, the business is firing, but the markets are firing. It's such an interesting time to be running portfolios and doing financial planning and hopefully I believe we are enriching people's lives. It's incredibly fulfilling. And I was explaining that to the new hire coming on and the research business, I did since 2011 and 12. I was just talking to the camera by myself. I'm trading my account. People are following along, but you don't really get to reach out and touch people. But, when you become part of someone's family and you see the skills that, all we've done in our professional careers, hone those skills when we can see that actually impact people's lives and enrich people. And it's really fulfilling, really fulfilling. So,
Absolutely.
yeah.
Yeah.
I mean, this is all you've ever done, Kyle, is in the wealth management. But it's just like when the research business, when you're just writing your own content and I don't have visibility into other people's accounts and it's just your trading account, it's kind of a shallow existence. But then going into this, it's such a transformation. You didn't go through it because
Yeah.
you've always been helping people. So I don't know, maybe
Yeah.
you're a better
Well,
person than
but
I.
I understand it. I mean, it's you when you go out on YouTube or anywhere and deliver information, it's up for the recipient to put it into practice
Yeah.
and execute and then be able to discern, what the best strategy is. So by us doing things this way with wealth management, we're able to work with clients directly and make sure those things that those smart financial decisions get executed. And so it's fun for us to watch from where someone starts to like doing a handful of things and improve their situation because we can look at it and see the value that we brought. So
Yeah.
it's
Yeah.
probably the best part of the job.
And I don't want to get too far off. I want to try to keep this concise here today, but it's like we've invariably heard this some form of this saying that people have. They're like, Todd, and Kyle, like, I just don't really have the time to do it myself. They're like, I could, but I just don't have the time. I want to focus on my family, my business, whatever they're doing. And it's like, look, these are people, and probably 95% of the people we're speaking to through this camera right here are more involved in the markets, more active in the markets than most traditional investors. And they've been studying the stuff that we've put out in other, educational shops about really rolling your sleeves up and get inside the market. And they're like, I just don't have time. And I'm saying to them, like, look, don't feel bad. Like, you have a profession, you have a skill that you've been pursuing for however long, or focusing on the family, or other things. Like, this is our full-time job, and I'm telling you, the markets are more complex, and the pace of evolution with the AI build out, and just the rate of change is happening right now in this economy, with what's going on in geopolitics, in domestic politics, and in the tech front. It's a full-time job. Like, it's
Hmm.
bonkers right now. It's not a casual
Yeah.
part-time thing anymore. Like, it's freaking busy. Sorry for my
Yeah.
terrible language, but it's like, dude, it's busy right now. Like,
Oh yeah.
it,
Yeah.
like,
And I mean, as far as like who we work with, it's because of your background and because of mine and our combined, approaches. Like we work really well with the people that are completely passive with it, and they're
yeah,
just like, hey, let me know what I need to do. I'll give you the info you need and let's work it out. Versus the person that's completely hands on, watching the markets every day, trading or percentage or all of their account and just listening to us. So I mean, we hit both ends of the spectrum, everything in between, and our it's a learning process with every client, but we're able to meet you where you are with your level of
yeah.
attention and how hands on you are day
I'm
to
not even,
day.
I'm not even talking about so much the client specific, and we're gonna get on. We have a really good presentation here for you today. But I'm like, every day I get up, there's some new deal between nuclear, between quantum, between AST Mobile doing a deal with satellites in space with Verizon. Like, every morning I wake up, there's like some new version of Star Trek going on. Like the pace of tech innovation right now is just bonkers, and the market's
Yeah.
reflecting it. Like, it's
Yep.
so hard to keep up every single day with like the new stories that are out. It's crazy what's happening right now,
Yeah.
but it's
Yeah.
awesome.
Have you heard of artificial intelligence before?
it's, it's so crazy. All right, let's get rolling. Perfect case in point. Look at this. The years after release, when Al Gore invented the internet, it kind of had a slow. You're too young to remember that. Had this slow ramp, 8 years, and then it started to hit sort of maximum delta rate of change, 13 years to get to 800 million users with the internet. It got to 800. ChatGPT got to just the same level in like almost 1.5 years compared to the internet's 13-year adoption. Like, this is bonkers. And that's from a source is the World Bank, from source from the Financial Times. Uh Pretty awesome. All right. So this was a big one. AMD has been a sleeper, unable to compete with Big Brother NVIDIA for a long time. And then Sam Altman at OpenAI says, "Oh yeah, we have room for AMD as well as NVIDIA." So they had announced a deal with NVIDIA for a massive amount. NVIDIA ripped, and now AMD is back in play. Kyle, you were researching this one. Anything you want to hit on AMD?
I mean, I would just compare the news that we're getting on a weekly or daily basis on these deals with these hyperscalers. I would just compare that to like the late 2000s and the level of earnings and investment and growth that we're seeing from these stocks versus like the dot coms and companies getting bought just because they had a dot com in their name. Like this
Oh
is a
yeah.
real structural build out with trillions of dollars behind it.
Yep.
It's a systemic change in this industry, and that's why it's kind of persisted, I think, for 2 years now plus. So it's crazy to watch the numbers and the the scaling continue at this rate, but
Yeah.
it's
And we're gonna have a
definitely
lot
real.
of we're gonna have a good comparison between late '90s to where we are now in terms of tech bubble. Tudor Jones interview on CNBC was interesting, making some comparisons. At Kyle's point, like this is a much different
Hmm.
tech build out where there's real earnings behind this, and not only that, like you know, I was talking to my former mentor. Guy was a guy traded for Tudor actually. I was on the phone with him for like an hour yesterday, and you're just talking about the differences between earnings and the valuations of companies that are leading this tech build out compared to, the high flying, just anybody threw up a website in 99, had a
Yeah.
premium massive multiple with no revenue or certainly any earnings behind it. But now, like you look at the semis that are leading this market up, you can't just blanket say like I want to be invested in all semiconductors. No, there's a lot of companies that are underperforming the return on SMH, which is the holder, the ETF that tracks semiconductors. You've got to be in the right names and the ones that are either
Hmm.
right for acquisition or the ones that are acquiring. As you said here, Broadcom is right in play. AMD is now in pretty good shape to, maybe a 10% interest will be taken in AMD from OpenAI. Like there's just bonkers acquisition and
Yeah.
consolidation happening here. So,
Yeah.
all right, let me see here. I've got a little. Okay, so next slide. Here's the AMD chart. We were quiet from 22, 23, 24. Let me just make sure. Can I? There we go. 22, 23, 24. Here's the big news on the OpenAI AMD. So a breakout is in effect. And look at the volume that went through on the daily chart of AMD. It's averaging out at about 60 million shares per day. And this is after this 3 days of massive volume. So whatever, it was probably a 5 handle, 50 million shares traded. We're doing 250 million shares, 100 million shares, massive breakout. And you know what? We don't have AMD exposure right now. I cut AMD out. It was dead money for a while. And you know what? This is another conversation, Kyle, that I had with I'll call him Mark, my old CEO, and he was at my wedding. Like he's took a company public. He's just traded for Tudor. He's just been a huge influence in my life. And we were talking about the style of trading and investing that you can use now, which is not typical, which is that you can buy breakouts. It's okay to buy strength. That's why I think the old IBD, Investors Business Daily, buying consolidation below highs or at highs, like it's okay to buy breakouts in this market because the follow through is there. The point is, like AMD now is at a breakout point here for the last 2.5, 3 years where it's investable. And if you look at the revenues that NVIDIA and AMD have experienced, 23, here we are, this is 24, and then this is 25. It's kind of a weird labeling here. But, you can see that AMD and NVIDIA between AMD in orange, NVIDIA in green were pretty much on par. And then 23, 24, 25, you look at the estimates for where Nvidia is believed to be in terms of revenue compared to where AMD is, like there is such a huge difference between these two where if AMD were to start to ramp up, perhaps AMD is very undervalued and you could buy the breakout. Now, there's a long conversation to be had. Could AMD close half of this gap in terms of projected revenues? Probably not. I think because NVIDIA is so vertically integrated with their CUDA software as it works with the GPUs and where NVIDIA is going. It's going to be hard to do, but I certainly think there's upside to go in AMD. So we may be putting AMD back in the portfolio. Let's talk about NVIDIA. We've been talking about this technical ceiling that NVIDIA has been caught underneath or below about 188 to, call it $190 through most of this summer. And then here we go. We're now in Q4. Yeah, we're starting to move higher. The ceiling is broken. The artist formerly known as Resistance, now Support, is in play. And that's a Prince joke. And I'm going to follow up on Prince in a minute. So looks like, 200, I think is a matter of when, not if. So this is just such a quiet breakout in Nvidia. I don't love the volume. There's no real catalyst. There's not a lot of catalyst for this breakout that would bring in big volume above the 50-day average. But price is more important than volume, and it's there. Cantor Fitzgerald just came through and gave an upgraded price target to $300 a share today. Massive. The last upgrade I saw was October 3rd. Cantor maintained its 240 and then today went to 300. KeyBank's at 250, Citigroup's at 210, Jeffries is at 220. So I mean, it's just the AI trade is just there. And again, if you look at the revenues expected, I showed you on the last slide where these are we're at what 200 billion in revenue for 25, going to 3, 4, 500 billion dollars in revenue. I mean, I just don't see how
Insane.
Nvidia, it's insane. How would they not be a $5
Yeah.
trillion market cap company? Um, so okay, so that's that. Taking a step back on this, and again, Kyle, jump in any time here. We're kind of all over the place here, but this again, the conversation I had with Mark, my old mentor, my current mentor, friend and mentor, we're just talking about the similarities of late 90s to where we are now. And this is a slide from, I think, a couple of weeks ago when we talked about Powell's Greenspan moment when he said the market was highly valued and the similarities between Greenspan's 1996 irrational exuberance speech. And I mean, Greenspan's, besides slashing interest rates way too quickly, which precipitated a housing bubble, that's a big part of his legacy is the irrational exuberance speech back here in 1996, where the market, the NASDAQ went from 1,000 to 4,800. So it just goes to show that central bankers generally are not very good at assessing the market environment. So you can't help but think back as we're in this next version of the tech build out. I think let's start to use some charts and get some perspective. And, as it seems that we're getting frothy and it seems to be there's a lot of talk about bubbles out there. It almost seems like there's a bubble in mentions of bubble on social media. Let's look at what we've actually done. Go ahead, Kyle. Is there anything you want to jump in on? I'm sorry if I'm just rambling here.
No, you're on the right track with all of this, and it's you know whether they're I guess, too early in spotting something that's driving value creation, and they're like, this will get to a bubble someday.
Yeah.
But just because you recognize that, like, just because it's whatever day it is, that doesn't mean the top's there, right? So it's something where yeah, obviously this is a driver of the market advancing. There are going to be some things that get speculative in these sectors because it's driving the most value creation, and some of them aren't going to succeed, and some of them are going to take a lot of the market share, like we've seen with Nvidia. And just because that happens on both fronts, just because you have a winner here and a loser here that got bought up because they thought this might play a bigger role than it ended up being, that doesn't matter. It
Yep.
doesn't mean that you should sit it out by any means, or
Nope.
that just because you recognize this will be the next thing where it's like, well, we don't know where it's going, so maybe it goes up a little more, and then, like, we're going to get to what Tudor was saying about kind of a blow off top at some point, in his opinion. Like, so be it. It could be another 100% from now, for all we
Yeah, yeah,
know,
yeah, yeah.
in market growth. So
Yep.
what watch things as they go, and stay in the winning stocks.
That's it. That's it. All right. So that's a good segue into this. Screen share. There we go. All right. So yeah, some context and perspective here. Since the GFC credit crisis lows, I count 67 quarters. since the 2009 lows. And to Kyle's point, like, again, the level of fear and uncertainty and, the again, I always say this, and people who listen to us somewhat regularly are probably sick of me saying it, but like, just the race for your attention is fierce. We're in the digital information age, and everybody is vying and competing for your attention, your clicks, your subscribes, your business. And fear is a more powerful motivator than greed. So people who have their own self-serving interests are going to try to tap your fear. So I love looking at the technicals and the charts to say, where have we actually been? Where are we now? And all the fear and all the stories that people have been trying to jam down your throat, which has caused chronic underexposure in their portfolios and has changed lives negatively. I love looking at charts just to get context. So 67 quarters since the 2009 lows, the Dow is only up 625% in 13 years. So what are the chances of a negative quarter? There's 17 negative quarters, 50 positive quarters, with the Dow up 625%. The most notable, obviously, was COVID, was a big one here. And then 2022 was pretty nasty. And then this is an interesting one, Q1 of 25, which we're going to get a little technical here and look at long-term on the indexes. So just kind of setting a tone of where we've been in the last 67 quarters. Okay. Here's the S&P going back to 1929 crash. Okay. 1929, there's the recovery in the 30s. This is the start of World War II. And then all the way up, roaring 50s, consolidation in stagflationary 70s, so on and so forth. So each one of these are called candlesticks, right? If it's red, that means we opened in the top part for the year in January and closed in the bottom, and opposite if it's a clear candle. But this is just a look at the S&P since the 1930s. And there's a couple cool technical patterns I want to look at in here. There's an outside bar right here in 2020 that we're going to talk about. And there's also, I thought, a really cool sort of ceiling in the market over the last 3 years in 21, 22, 23. So I kind of want to look at that and just look at longer term technicals, longer term price trends, and say, where have we been? Where are we? Where maybe are we going? So this is an up close look at the S&P from the prior chart. Okay. So each one of these candlesticks is 1 year, 2017, 18, 19, 20. The technical significance, and just bear with me if you're an investor of ours and you don't know us from our old life and you don't even know, why are you playing with candlesticks and colors and crayons? You guys look like fools. Just hang with me here. COVID was such an interesting year in terms of technical price behavior. What this means with this long tail, which means is in 2020, January 1st, the S&P was right at this level. During the year 2020, the market traded all the way down to this price point. But then the fact that it's a white candle means, we started here in the bottom left. And then at the end of 2020, we finished here. So round trip in 2020, we opened the year right here in the bottom left part of this white body. We closed the year up here at the very highs, but intra-year, we went all the way down to these lows. And what this means is 2020 moved below the low of 2019, 2018, 2017, and dipped into the 2016 body. So, we were trading basically the same price in 2020 as we were in 2016. What this means from a trader point of view, you think about anybody who's, let's call them weak-handed, or anybody who's prone to capitulate or sell positions because they're fearful. Anybody's like, wow, if we go below 2029 or 2019, I'm selling all my stock. If we go below 2018, I'm definitely selling all my stock. If we go below 2017, I'm not looking at the stock market again. So it cleared out the lows of the prior 3 years only to snap back, right? Then what happens is 2021, we put in a high here, open 2022 here, close down here, open 23 here, close back up here. We had this triple top over 3 years. I think people like, oh, we're going to go down and try to get back into these 2017, 18, 19 lows, which we didn't. We broke above and then we're off to the races. So there's two just behaviors of markets that I'm trying to draw your attention to, which is one, we cleared out the lows the last 3 years. It definitely sucked a lot of people into getting out of their stock positions. And then the fact that we hung out here for 3 years and then didn't get rejected and then just went higher. What this is saying is all the weak-handed sellers are out, maybe didn't get back in. The fact that we broke above this is significant. What this means is there's probably going to be a lot more follow through on the upside because of these two technical developments. Okay. And Paul Tudor Jones, who's kind of my trading hero, again, my mentor I spoke to on the phone, we talk a lot. He worked for Tudor Jones. He was actually the one who originally introduced me to Elliott Wave. He was a portfolio manager for Tudor. And, I'm just looking at this. He's like, even Tudor was like, it's like 99. And this is a quote from the interview that Tudor Jones did with Andrew Ross Sorkin at CNBC. Tudor, if you don't know, he's a billionaire hedge fund manager. He runs the Robinhood Foundation. He raises, I was in the room. I got the invite. Mark brought me into his annual fundraiser for Robinhood. I watched him raise $50 million for charity. Like Dave Tepper, hedge fund guy, was there. Paul McCartney was the music. I was there another year. Bruno Mars was the music. Like, it's the biggest hitters on Wall Street. Tudor has made himself billions of dollars running money. He was using Elliott Wave back in 87 for the 87 crash. He was 20 something years old and made himself a ton of money. So Tudor is like kind of a famous macro hedge fund manager. Now, it's a longer conversation, but I think a lot of the hedge fund guys, billionaire guys, have come on and been wrongly bearish for a long time because they're kind of in protection mode. They're not in growth mode, but that's a different conversation. So Tudor was like 6 months ago, in the last couple of years, he's come on, been very bearish. Global debt's going to explode. Like, be careful, blah, blah, blah. He came on 2 days ago and he's like, basically, it's like party like 99. And then he went on to say, like, don't forget all that the NASDAQ doubled from October of 99. All the ingredients are in place. And from a trading standpoint, you have to position yourself like it's October 99. I don't see why you would do anything but that. And remember, the NASDAQ doubled between October 99 and March of 2000, but walks like a duck and quacks like a duck. So you get the combination of central bankers like Greenspan saying the market was irrationally exuberant back here in 96. Then Tudor saying, well, okay, maybe the market is in like October 99, which ironically is 26 years ago to the month. The NASDAQ went to double to 245%. And again, take our word for it, the earnings behind the companies that are jamming this higher are there, unlike what was happening in 2000. And yeah, the market did get cracked in 2000. And he is saying, yeah, there's going to be a time where the market sells off hard with tech. Okay. And we'll come back to that. So sort of that same technical pattern. Remember, I showed you that long candlestick that ran through the lows of the prior bars? Well, the same thing happened in October of 99. What do you see here? So here's a zoomed in view. This is October of 99. This is, these are monthly charts, not quarter or annual. These are 1 month. This is October 99. Same kind of concept. It ran below the lows of September, August, July, June, and May. And then I can keep going, I guess, April, March, February. So whatever, it ran below the 8 months of the prior bars. And then that's what set up this massive 245% rally to the ultimate all-time highs in the NASDAQ, for which a lot of the companies didn't have real earnings, which is very different than what we have now. So if you look at what's happening right now in the NASDAQ, now we're on quarterly candles. Each one of these candles is 3 months or 1 quarter. Here's back to 98, Q4 of 98, which we're talking about October 98 and into October 99. But, You look at Q4 of 98, there was a similar sort of run below the prior two quarters. There was a low candlestick, which set up the run from 98, 99 into 2000. We had kind of a similar thing, I would say, in Q1 and Q2 of this year. We had a big sweep down. We had a huge sell off in the beginning of this year. It cleared out the lows of the prior 1, 2, 3, 4, almost 5 quarters in the beginning of this year. And then this is what set up the sharp V-shaped recovery this year, which April just went down to the low, caught so many people off guard, and it just V-shaped all the way back. Everyone was waiting for the September week seasonalities that we've been talking about, and the market didn't give an entry to anyone. And it's what I said earlier, like you have to be comfortable buying breakouts because we're in a breakout kind of market. It's okay to invest or buy companies at all-time highs. Like we're just ripping. So it's a similar Q4 of 98 quarterly pattern that set up a move from 1700 in the NASDAQ to 4200. Like that's life-changing money, Kyle. And it looks like, oh,
Yeah.
be careful, we might crash. Dude, NASDAQ that goes from 1700 to 4200 in a year, like if you're properly positioned and you can be, as Tudor's going to say in a minute, have happy feet, like you got to be able to actively manage this. Like this is life-changing money that's potentially ahead of us. I don't know. I mean, we're going to try our
Yeah.
hardest to capture this. Go ahead. I'm going to take a breath.
It would be easy to lose your purchasing power if you, or it would have been if you had listened to Greenspan in 96. And then, I mean, to go further, what if you had waited for a drop of, maybe into '01 when you do have the two positive bars there
Oh, in
and bought back in
oh right,
only to have it continue to go down
right,
there. Yeah,
right, right.
exactly. So it's like you in your head or in your planning, it's like, well, I waited for the crash, but you missed more of an uptick than the size of the crash because
Yep.
the bull market in the 90s was bigger than the correction or bear market in the early 2000s. And then it's like you have to nail so many decisions of when do I sell, when do I buy, how much, versus managing your, keeping some invested, managing your risk at the margins and creating value that way just by not, because I mean, being in cash is the same as being in any one security. Like if everything else lines out perfectly, like you're going to do well. Just like if you own one stock. But if the market rips, inflation stays high, I mean, you're losing your purchasing power and you're not diversified.
Well said. Well said. Well said. All right. So Q2 of 25, here's where we are. Okay. This is more from Tudor, and this is quotes right from him. Again, this guy's a billionaire, and he's a trader at heart. Uh, and he says the greatest price appreciation in bull markets is always the 12 months preceding the top. If you don't play it, you miss out on the juice. If you do play it, you have to have really happy feet because there will be a bad ending. Ingredients are therefore blow off top or in a period that's conducive for massive price appreciation for a variety of assets. Again, like we've had this conversation with our investors that even our SIG portfolio, which is our dividend, our individual equity dividend portfolio, is pretty juicy right now. And we've made the commitment, and I'm making the commitment to all of our investors. Like we're pretty aggressive in the dividend portfolio right now. And I watch it every single, not only day, but every hour. Like we're going to ride this thing as long as we can. We're going to make as much money. We're going to try to make as much money as we can, even for our more risk averse older clients or clients who are just risk averse. Like we're going to try to make as much as we can, but not take our eye off this because as Tudor was saying, he's even capitulating. He's been wrong for years. He's a billionaire. He's like, he's been, a lot of the guys coming on are not bullish on the market. Now Tudor's
Mhm.
is saying, okay, maybe we're going to ramp. So I'll watch that. But like he's saying, well, we have all of a sudden we have a pretty good budget deficit. We have the Fed set to cut another 2 to 3 times into an AI build out with companies with real earnings, combined with the technicals of the market, which are still vastly under invested because people were still waiting for any kind of pullback following the April low. Like there's a lot of things coming together. Like we're active management. I mean, we could change our portfolio in an hour, right? Firm wide. Um, and we're completely ready to deal with some volatility or sell off when this thing does come off. But like on the other side, we could completely rip on the upside, and we need to make money now. And then, I'm not going to sell the top. We are going to get out as the market starts to roll over. But we're going to ride this thing as long as we can, and there'll be plenty of time to be conservative and make our 5-6% yield in something safer. But now I think we need to get after it. I think everything's coming together where we could ramp in the end of the year. But I'm not an analyst. Like I'm a trader. I'm a portfolio manager. I'm not telling you what's going to happen in the future. Our job as money managers, and my job specifically as a portfolio manager, is to assess the now every single day. And Kyle tempers my bullishness.
Yeah, without trying to call tops, because that's a fool's game, especially in
Right.
a market like this. Like we have
Yes.
to see something systemic change from away from how things have been. I mean, to even get close to even trying to do that right now.
Exactly. Yep. All right. So well said. Let's move on to something more specific. Interesting news. There's a possible Xi-Trump meeting coming up. Tensions are getting a little strained again between U.S. and China. Somewhat related. Before I jump into the rare earth mineral story, things are getting speculative again. Related to the last slide, like I'm seeing crypto start to move up. Like we're seeing some speculative altcoins, crypto, DeFi, decentralized finance, which is very much related to the digital economy. We're starting to see things ramp, which is making me bullish into the end of the year. Okay. And related is Trump's focus on securing our energy, our independent energy sources, our defense materials. I think, again, the Ukraine-Russia situation was a really good reminder that a sovereign nation's most important resource is their energy independence and to power their country. I think a lot of people lost sight of that, and Trump, for whatever you're feeling in Trump, is his view is protectionism and independent energy and material supply. And the market seems to be responding well to it. So shares of U.S. rare earth and critical mineral miners surged Thursday after China threatened the export of anything that is domestically sourced. They need to obtain a license to export products that contain more than 0.1% of domestically sourced rare earths, according to China's Ministry of Commerce. They'll need an export license if they use China's extraction, refining, or magnet recycling technology. They're 85% of the supply of rare earth mineral. And what we'll talk about is rare earth minerals, magnets specifically, go into a lot of defense products, a lot of EVs, a lot of the technologies that we're talking about that are driving this. So they're saying that they're playing some games ahead of a possible meeting. I don't think it's scheduled yet between these two. I read that it could be a week or two away, but the fact that they clamped down on exports, required exporters to get a license, so on and so forth, our rare earth mineral suppliers ripped. Ramaco Energy Fuels, USA Rare Earth, and MP Materials, which we hold in the portfolios that we'll talk about. So Ramaco, here's the daily chart of Ramaco, is up 10.8% today. Energy Fuel, symbol UUU, is up 13.78%. US Rare Earth, symbol USAR, is up 18% today. Trilogy is up 4.9%. And that was after a massive gap from $2 up to $7. So we're seeing some huge moves in rare earth minerals. Again, this is the stuff that makes this technology build out possible. So MP Materials, we're going to talk about this company. the U.S. Department of Defense, which I just learned was renamed to the DOW, Department of War, quite to the point, uh, took a stake in MP Materials. The government, and they're getting a lot of criticism because they're taking stakes in companies like Intel, like MP Materials. There's a few others. Again, they're trying to secure, our semiconductor, or trying to, I would say, win back some of our semiconductor share while secure rare earths and other mineral and energy. So as I said, China controls 85% of rare earth. As a matter of national defense, the admin stepped up to shore up the business. Um, so, oh, that's a note for myself. I meant to take that out. Sorry. Vertically integrated supply chain. So MP Materials CEO James Litinsky was on CNBC, and he did a really interesting interview with those guys. CEO says we're at crisis levels for rare earth minerals magnets. It's critical, essential, and the feedstock to the future of warfare and physical AI. Apple is also a foundational customer for as they recycle out some of their material. Apple is their biggest customer. So I was posing the question, why was MP Materials losing so much money in 23 and 24? So we're looking at free cash flow here in the green, losing money 23, 24, 25, expected to go slightly free cash flow negative in 26 and then ramp up in 26, 27. The orange is revenue. Okay, so revenue kind of flattened out here, 23, 24, 25. The government took a stake. Here's what analysts are expecting to go from, 700 up to 1.2. So here is EPS expected, losing money 24 into 25. Markets are looking for 86 cents in EPS for all 4 quarters, $1.35, 156. And this is the free cash flow year over year change. So the company is looking to go from free cash flow negative to the positive. So they did a big retool. They shifted from selling concrete to producing segregated NdPr, which is building of the rare earth magnets that are key in defense and semis and other products. Okay, so
Yeah.
go ahead.
Just part of that deal that they made with the
Yeah.
U.S. government was to before they would it was like I guess aggregate that they would ship to China to have processed into magnets, and then part of the deal was for them to stop doing that and to build their own capacity here to
Yep.
make magnets here instead. So it
And
was like
they shipped
there
to
was a
Texas to
matrix.
produce MP, and I've got to look
Yeah,
more into the factory, but they shipped to, I think it's I don't know where in Texas, but they process it there. So sorry to interrupt.
yeah, no, that's it.
Cool. So you look some of these share appreciations. MP, we have a position in MP Materials. We have it in tag. I added it in on September 15th for the new position, September 15th. We also have it in Active Opps. MP looks like total returns up 12.44%. So, you know, decent little return here, but we're just getting started. From the technical point of view on MP Materials, this is the monthly chart. So I'm going back to 22, 23, 24 when they dipped into, negative free cash flow. The government takes a stake. We're starting to get a big focus on domestic production of rare earth magnets. Broke above resistance. So the concept of what was resistance broke and becomes support. And those of you who know me from the old world might recognize a little Elliott wave triangle pattern here as we're hanging above the artist formerly known as resistance, now support. So MP Materials, even though we're up 12% on the position, probably roughly the same in tag. If we can break this consolidation on the daily, break up through 83, I mean, I don't see why this thing can't break above 100 to go up and hit some of our higher targets in coming months. And again, the expectations of Wall Street analysts as they're continuing this evolution out of concrete into rare earth is going to take hold. And keep in mind, the markets don't trade based on what's happening today. markets discount when it happens 9, 12, 18 months into the future. So that's why you need to have a combination of the fundamental expectations and what's actually happening on price action, because you need the two together. Okay, so that's MP Materials. Gold. Gold has been a huge ripper, and it kind of keeps me up at night. I love the stock market. I love what's going on with rates. The dollar is dropping, but gold is one of the best performers of the year. And as I said, it kind of leaves an uneasy feeling. Kyle, jump in here. This is you.
Yeah, so one way to explain gold's appreciation this year, there is a healthy retail market for it, but what you can see on some of the charts here is how central banks around the world have started, and this graph on the left is all international central banks combined. You can see how the dollar is basically in the, I guess, pre 1991 or so. Gold was just a massive 50% plus in some cases percentage of what the central banks are holding as reserves. Post 1990, 1995 or so, you can see U.S. Treasuries with the dollar as kind of the dominant reserve currency of the world, getting up into the 25-30% range. And then just here in the last couple of years, there's been a lot of geopolitical trade stuff going on. You've got countries like China. You can see this headline here. They've been buying gold for 11 months, and it's a lot of gold. Same with the U.S., same with Europe. So you've seen kind of a shift away from the dollar towards gold, and this is, at the highest institutional level, right? Central banks really jacking up their gold reserves. Possible explanations, like I said, I mean, there are a lot of countries looking for neutrality. You do have China, which is, has its problems with the U.S. right now, looking and not looking, but actually decreasing their level of treasuries and then buying gold. And then you also have citizens all over the world. You've citizens of China itself that are scooping up lots of gold. So definitely, I mean, if you want to go to the next slide, this is something we kind of tapped on last time, or you had brought it up, but gold has actually outperformed Bitcoin this year,
Which
year
is
to date.
crazy. It's
Crazy.
it's
If you go any further back, you're going to see Bitcoin heavily outperforming,
yeah,
like
yeah.
at the 1 year, 3 year, that. But this year has been different.
It's amazing.
And
And the gold miners, the GDX is, it's multiples of the return. I don't know, maybe not multiples, but
yeah,
I bet you GDX is up 80, 90, 100% on the year. I could take a look. Like
yeah,
that's interesting. And man, I mean, perhaps it's two separate markets. Like banks, foreign central banks decreasing their holdings of U.S. Treasuries compared to international reserves, increasing gold. Are those going to be, equity, stock market investors? Are the two signs related? Confidence in the U.S. on the central bank level are decreasing because of protectionism, so they're going into gold. They're selling our rates, or selling our bonds. Rates have, gone up, but that was from 2022 inflation. And
yeah,
rates have been sideways for 3 years. So it's like central banks
correct.
selling treasuries have not spiked rates to the degree that they told us it would, how it would be a
Right.
debt implosion. The US 10-year yield's been sideways for 3 years. So
Mhm.
I, are the two independent? Can you have gold moving up as central banks diversify into gold, as really our treasury market hasn't been slammed? And Kyle, this is on top of the Fed's quantitative tightening, which is decreased, letting the balance sheet roll off. Like, so they're selling, there's non-renewal of debt from the US government. There's foreign central banks diversifying out. You think there'd be a debt implosion and rate spike, but
Mhm.
it's not happening.
Yeah, and there are some things going on behind the scenes. I know banks have been getting encouraged to buy more treasuries, and as the Fed kind of decreases their treasuries, I know banks have picked it up a little bit.
That's interesting. So I
But
think I would you agree the takeaway, the conversation we're having is like and I feel myself getting cautious. Like, what macro signal with gold so bid is that telling us with regard to our stock market bullish outlook? And maybe the two are not
yeah,
so related. Is that, would you,
yeah.
do you agree with that, or are you like hold
I
hold
mean,
on there,
if
Todd?
you we'll put a chart on top of each other for next time, but there is a pretty good correlation between gold and the market and the S&P, through a lot of periods, not all. And that's been more recent, but yeah, I think it's just a combination, but I do see like people giving up yield to go into neutrality with gold,
Hmm.
and that's interesting to see because I mean, as we know, gold doesn't you don't get a dividend for owning gold or any interest, so it's really, I mean, I think probably the market has played a role where you have people that are taking gains or took gains and they want to go into safety as they view things, having done so well. I think that might be like psychologically part of it, but I'm I'm coming around to where, like we were talking about the stock market continuing to go up. I mean, where does gold come back from here? It's definitely something we're researching and thinking about.
Yep. Yep. I mean, and also like we could just rely on the traditional old school macro relationship, like lower dollar is bullish for gold. I mean, that's going to be a
Hmm.
component, and the Fed is cutting rates, so they're going to cut 2, 3 more
Yeah.
times
Yep.
as the interest rate differential of the U.S. compared to the rest of the world shrinks. The attractiveness of the dollar, comes off, and then as the
Right.
dollar drops, that's generally a bullish thing for our stock market because we have so many multinationals that are earning money overseas and repatriating home.
Exporting.
Yep.
Yep.
So just lower dollar, higher gold, usually good for stock
Yeah.
markets, which is
Part of
why
it.
there's a lot of times the last 5 years there's a positive correlation between gold and the stock market, which people can't really wrap their mind around. And maybe I'm one of them still. But okay. All right. So I think that's going to be we're going to circle back to the birthday, 4 years.
Yep.
Yep. Yeah, this is so we don't normally do this. We don't try to tout returns. We're trying to head down and, our clients know how we're doing, but we're 4 years in. And again, it's the conversation I had with, my old boss. And I'm like, just in today's market with active management, with the AI boom and the access to information that everyone has now, like it's not hard to find the names that deserve to be in our portfolio and the names that don't. I'm not saying that we're forever going to outperform. But since 2022, here's where we've been. Kyle, take it away. You're more measured in what you say than I am.
Yeah. So if you're reading this and you want more information on any risk metrics or anything, feel free to reach out because this is just a snapshot. But you can see a chart here along with a couple tables. This is our growth model. We call it tactical alpha growth or TAG. You can see the aggregated or kind of cumulative performance since October 4th, 2021, with the S&P in orange and our growth model in purple. The tables below the chart, those are going to be performance figures at different time periods. So we've got 1 month, 3 month, 6 month, and year to date. Those are cumulative. And then we have the 1 year, 3 year, and then AT all the way to the right. That's all time. Those three figures with the asterisks, those are going to be annualized. So you can see a 17.9% annualized on the growth model. Top right, there is a note that this is assuming a quarterly or an annual fee of 1%.
So
And
this
then,
is including the
yeah,
1% fee.
right, 1% per year. And then just a couple notes on allocation, just how this is a stock model. So 95% in stock. The other 3.06 is probably Bitcoin.
Mm. Yep. Yep. Right there. Yeah. And
Yep.
then,
So
and
yeah.
that's tag. And then this is SIG, strategic income and growth. This portfolio is again individual equities that everybody pays the dividend. But kind of what we're saying, this is our more conservative equity portfolio. But right now, as the market is moving towards highs with the AI build out, we're more aggressive than we otherwise normally would be. But yeah, so go ahead on this one.
Yeah, exactly. And you'll see, and we do have, specific risk metrics like maximum downturn of both models since we launched them, with the tag model, the previous one being more volatile, usually more volatile than our benchmark, to where when the market goes down, assuming we don't lighten things up on risk, it would go down more versus when markets are going up, we would expect it to outperform the market based on how we've situated it. Whereas strategic income and growth, these are our more stable stocks. And we've been in a growth market the past few years. So, like Todd kind of mentioned, we did go out and get some more growthier dividend stocks to put into this model. If we compared it to like the S&P 500 value stock ETF, so only companies that are value stocks in the S&P 500, it actually comes in below the broad S&P 500. So, for us to not kind of get stuck with value stocks in this model, we did have to, here it is. But
Yep.
yeah, we did have to bring in some more growth oriented dividend paying stocks to make that happen. And yeah, here you go. It's showing the S&P at 66% and the S&P 500 value ETF at
The,
41%. So,
and this is going to understate the value ETF because I don't know if there's a metric to put total return in there for the value. So
oh,
it's, I mean, but it's a striking underperformance. I mean, so I would, it's probably not accurate to put out there because we'd have to put the
because
total.
it
What's, yeah,
needs
go
a
ahead.
dividend in there.
Yeah, the reinvested dividend. What's the IVE yield? I have to look at that. Expense ratio is 0.18 year to date. What's the yield? What's the yield? What's the yield? Key facts, closing price, premium discount.
Try
One. It's actually 1 point. Here it is, right here. 1.75.
you might try SPX VTR.
What is it?
See if that SPX VTR,
VTR. Oh, look at you.
right?
Good job.
Not my first rodeo.
That's interesting,
But
actually.
yeah,
Oh, look at that, dude!
another
And I guess
percent.
54. So
Nailed
it's
it.
54.63 is the S&P 500 value. S&P total return, and again, October 4th to 21's our, that's our 4 year, 66, and then SIG is at 76. So, listen, we're not going to lead all the time on performance. Let me pull this out of here. Where do we go? I'm losing screens here. There we go. Yeah, we're not gonna lead on performance. There's no guarantees it continues. I'm trying, Kyle's trying, we're absolute best. Anything can happen in the markets. We could be on the wrong side, and we probably will underperform it at some point. But we're all
Mhm.
aligned. My money, Kyle's money, my parents' money. We're all in the same portfolio. So I can tell you we're trying our absolute hardest. And even if my money and my parents' money wasn't in, I'd be trying my hardest anyways. But
Yep,
yes.
absolutely.
So I think,
Or
into year end, let me just finish this and I'll stop. Like, I don't know. I want to put some more on top of this. I still think, like kind of what Tudor was saying, that we could ramp in the end of the year. I'm going to try to do as much as we can here, cause as much damage as we can on the upside, but we're never gonna fall asleep and let this thing come back too far without being defensive. And I think, in today's market, like if your money manager is asleep and saying just ride it out, the market will drop 20-30% at some point. It absolutely will. And if you have to
Mhm.
sit through that when you're 65 looking at retirement, that's stressful.
Yeah, yeah, definitely. And just to close on those models we shared, I mean, if anything, that shows that you can be in all stocks but have two different outcomes in terms of like what type of volatility you're seeing in your account. So, that's something we work with clients is, which model works best for you. And we have a variety of tools and conversations, targeted conversations where we try and figure out, exactly what your kind of your ideal allocation is. And that's a big part of what we do.
Yep. Well said. Well said. Well, let's finish that up. I just want to say, where is I just want to remind you guys of our disclosures. We should probably leave it on there as we're talking about performance, which is not something that we normally do.
Absolutely.
So that's that. Thanks for joining us, everyone. I hope that was helpful. Happy Thursday. And I can't believe it's already Thursday. So we'll see you back here next week.
Yeah.
Check us out, insideedgecapital.com. And sign up for consultation. You can talk to Kyle and I and see if we're a fit for each other. Some are a fit, some are not. And if not, we'll have to catch you next week.
Thanks, guys. See you in a week.
See y'all. Thanks, man. Talk to you soon, Kyle.
Talk soon. See ya.